Hey, this is Sasha, and thanks for joining me here for another video lesson about stock trading and investing. And in today's video, what I want to do is share with you another frequently asked question that I get on my channel and through emails. So today's question is, what is the purpose of hedging? So first, let's take a look at what hedging really means, or the word hedge. Okay, so typically the root word comes from limiting, or oftentimes referred to as restricting or confining. Similar to a garden hedge that acts like a border around a property, you have the same thing in the stock market. There's a little bit of a border, there could be restricting, some confinement, and that's really ultimately what you're doing when it comes to hedging in the market. So what's really the point or purpose behind hedging in the market? Well, it really comes down to watching the risk, because investing, the stock market, it all comes down to looking at your risk and the trades and investments that you have on hand. So if you have so much invested in one stock, then you're over leveraged in one security or equity, or over invested. So what you want to do typically is, as news or things come out, you're looking to hedge, you're looking to confine or restrict that investment. And really, that's the goal and the point. So if we take a look at this on paper and we start drawing out an investment scenario. So let's just say you have 100 shares of Facebook, you might have 100 shares of Amazon. So these would be your investments. And then you have another 100 shares of Microsoft. So you can see that all of these are tech companies. Okay, so if you're looking for tech to explode, these are fine investments as a general concept, right? But if you want to hedge this, let's just say you assume that technology is going lower, then what you could do is hedge this by taking another investment in, let's say, something like Exxon Mobil. So that's kind of another way to hedge, is that now you're looking at sector hedging. Now, the other approach that you could go ahead and hedge is something that goes a little bit more against the market, or something that's a little bit different. So if we had the same type of stocks or investments on this side, what you could do is you could hedge just slightly differently. So instead of doing a hedge with ExxonMobil, you could hedge, let's just say again, 100 shares of something like GLD or the gold ETF. Again, this is all just conceptual for educational purposes. I'm just using them as examples, but you get the idea. So now I'm looking at one side is more of a sector hedge. This side is more of doing something that's a little bit inverse to the way the market moves. And of course, you could do an ETF or a bearish ETF or something else. So now that you have these two concepts down, you could also look at hedging a lot more. So for example, you could see that right here in this hedge, we only have 100 shares hedged to cover the 300 shares that we own. Okay, so right now this is a minimal hedge. So what you could do, the same thing over here, is rather than hedging, let's say 100 shares, assuming everything is equal in price and so on and so forth, making numbers easy, I could hedge by 200 shares, I could hedge by 300 shares. If I really thought things were in trouble, I could do a hedge by 500 shares, whether that's ExxonMobil or even over here by gold. And I could do a hedge that's completely a lot larger than even my holdings or my positions. And what this does is allow me to look at the market and see if things are going to reverse, then at least I'm compensated on this hedge, on the thing that's covering. But basically what this does is this goes slightly against what I normally own to help compensate if things go against me. Now, one of the great things about hedging is also looking at the time frame. So if we take a look at a time frame, you can simply do a hedge for a shorter time frame. So let's say this is time frame A and this is time frame B. And as time moves forward, you could do a hedge based on something that's happening in an event. So let's say something is going to happen over here, whether that's interest rates rise, earnings reports, something is going to happen in this time frame. And you own a stock, call it XYZ. Okay, so as you own this stock and you approach this time frame where you think things could be a little dangerous, what you could do is now create a little hedge right here, and again, whether that's gold, ExxonMobil, something opposite of your XYZ, it could be shorting the market, it could be buying a put, buying a call, whatever it is, you could get it for just this time frame. So now it hedges you for this little bit of time frame in case your investments go against you. And then right here, you would simply get out or get rid of that hedge right there and still continue to use your XYZ. And that is just in case your XYZ position goes lower, at least your hedging position goes higher and it compensates you for that difference. Ultimately, that's the goal, so you don't lose as much money from your primary investment. Now, of course, every time you put on a hedge, whether it's right here for a shorter time frame or even a longer time frame, it's going to cost you. It's going to cost you time, money, and energy and resources. So if the stock is actually going in your favor and XYZ continues to move higher, then this hedge ultimately is going to continue to lose value. So if you overvalue or overhedge, it can actually work against you. So your goal is to hedge enough to where you're protected, but not too much to where it can actually cause you even more problems. Because otherwise then you'll get whipsawed back and forth. So there you go. I hope you get some insight regarding some hedging concepts. Of course, this is just a baseline idea about hedging, and things can get a lot more complicated. You might be wondering, why don't you just put on a stop or continue to raise your stop? Well, the fact is that if you put on a stop or keep raising a stop, what if in that one day or that event, that stock tanks and goes down 10, 20, 50 points because of that event? So that's one of the reasons why you hedge. The other reason is going back and forth on your position, especially as you start trading larger. Getting back in and out is just costly and time consuming. So you want to just protect yourself because your hedge is a lot smaller of work or amount of capital or amount of resources that you need to use to protect your primary position. So if your primary position is, let's say, 50,000 shares and you might only hedge with, let's say, 4,000 shares, then it's a little bit more cost effective than getting out of your 50,000 shares, getting back in them later, raising your stop, and so on. So instead, you're just looking to protect that position. So I hope this makes sense. If it doesn't, send me an email and I'll explain it to you in a little more detail. Thanks for joining me in this video. If you want to see some of my books, then go ahead, click this button right here, and you'll see some of the books that I've written about stock trading and investing. And if you want to see some more other training videos, then just click this thumbnail right here and you'll continue watching and learning with me. In the end, remember, do what you love, contribute to others, but most importantly, live life abundantly.